The drop in oil is considered deflationary. The Federal Reserve wants to see more inflation. And today, the central bank released the minutes from its latest meeting when policymakers raised interest rates for the first time in 9 years. As Steve Liesman reports, the decision for some was a close call.
Minutes from the Federal Reserve's December meeting show that all Fed members agreed that the labor market and inflation data had shown that the committee's criteria for hiking rates had been satisfied. All members also agreed that future rate hikes would be gradual. However, for some members of the committee, that rate hike was actually a close call, and they say they're going to want additional proof that inflation is moving up towards 2% before they hike again. The Fed gave 4 reasons why rate hikes would be gradual. They include the idea that the inflation outlook is uncertain. Second, it allowed the Fed to assess inflation as they go. Third, the neutral rate, or the rate where unemployment and inflation are balanced where the Fed wants it to be, it seems to be right now around 0 and will rise only slowly. Finally, it's harder for the Fed to fight deflation, so it's going to err on the side of hiking rates more gradually rather than more quickly. In a CNBC exclusive interview, Fed Vice Chair Stan Fischer was asked about the Fed's median forecast that there would be 4 rate hikes this year, and here's how he responded.
Those numbers are in the ballpark. But, you know, the reason we meet 8 times a year is because things happen. And as they happen, you want to adjust your policy. Otherwise, we could meet in January and close down shop until a year later. But we have to react to incoming events, and we will react to them.
Fisher said he saw continued uncertainty from around the world, including from China, and from the possibility that North Korea may have detonated a hydrogen bomb. But the committee, in the minutes, in deciding to hike rates, said it saw global risk receding and expected some improvement from the global economy this year. However, the drag on U.S. net exports from a stronger dollar, they expect to be around for some time. Among the other lingering concerns was further dollar appreciation, persistent commodity weakness, and further difficulties out of China. But they did see some upside risks, including lower energy prices spurring better consumer spending than expected. Ultimately, most in the market think the Fed will take a pause in January, not hike rates, and then reconsider the issue again in March if fourth quarter weakness that we've had, with GDP running only around 1.5% for the fourth quarter, turns around in the first quarter. For Nightly Business Report, I'm Steve Liesman in Washington.